Good afternoon, everyone. Whether you're catching this live or you are watching the recording of this, welcome to the live today on LinkedIn, Facebook, and YouTube. So anyway, we're going to be going over a few things concerning Nelson Nash's book, Becoming Your Own Banker. So if you don't have this book, you definitely want to get it. Let me know if you don't have it, and I can help you with that process. Show you where to get it. Now you can get this on audio. You can get it on Audible. You can get it on paperback, or you can get it on the Kindle version also. The Kindle version is pretty inexpensive, and so is the Audible version. And so it's an excellent book. Nelson is the originator of the concept, really kind of putting it into an easy to understand way as far as infinite banking goes. And that's the use of a dividend paying whole life insurance policy as a banking system, not an actual bank, but a banking system for your family, for your business. And so we're going to talk about one of the concepts from that today. The last couple of weeks, I dealt with the concept of taking your expenses, your mortgage, things like that, and being able to funnel that through this system, and actually have no increase in cost to your family or your business over a monthly period or quarterly period or whatever it might be, even though you're still saving that money, which is pretty amazing because normally we save the surplus, right? That's the way we look at it. We're also always focused on rate of return. Right. Well, in this case, we don't have to really focus as much on rate of return, though we got a great rate of return in these systems, because it's not about that. It's about the volume of savings, right? Because we're saving dollars we wouldn't normally save. Normally, we're just spending it. Those dollars leave our family, they leave our household, and they never come back, right? And that's what we want to avoid. We want to get as much of those dollars to flow through our banking system. You have direct deposit at your bank, right? For your work or whatever you have for revenue and income coming in. And all those dollars pass through someone else's bank, whether it's, First Security, Bank of America, Bank of the Ozarks, whatever it is, what bank you use, it passes through that bank and they get to benefit from that. And it's a great profit center for them. How much of that do you want to pass through your own banking system? That's the question. So Nelson uses an interesting concept of cogeneration to help explain the value of these whole life policies through these mutual carriers who've been around for 120 plus years. And in his book, he explains this concept. So in chapter 5 of this book, if you look in here in chapter 5, this is the 5th edition. I think there's actually a 6th edition. He talks about creating a bank like the ones you already know about, right? What would it take to create a bank? If right now you said, I want to start Bank of Daryl or Bank of whatever, right? You want to start that bank. What would it take to do that? Well, you need a lot of capital for one, probably in excess of 20 million easy, right? You'd need to be able to get a bank charter, which is not easy to get. There's a lot of things you'd have to look at. Okay, now we got to build a location. Maybe it's just an online bank. Even then, you're going to have to go through a lot of hoops to get this done, right? So it's not a real feasible thing for the average person to say, hey, I'm going to start my own bank because it's a profitable thing. And if you're questioning whether banking is profitable, look at how many branches there are in your town and who has the nicest buildings besides the county and the state, by the way, the feds. Who is it? It's the banks, right? They have great buildings. Why? Because they're making some money. When they give us, less than 1% sometimes on our money, and then they loan out, they can only loan what's been deposited at the bank, right? And they loan that out at 12, 15, 20, 30% on some of these credit cards. It's crazy, right? They're doing pretty well. Right? So in chapter 5 of Nelson's book, Becoming Your Banker, he talks about creating a bank like the ones you already know. It's not that feasible, right? It would take a lot to go through that process. And you don't need to do that to accomplish the same task in a similar way. And so he gives an alternative option, and he uses the example of cogeneration to explain it. So he uses the example of sawmills and paper mills. You remember, Nelson is a forester by trade when he first started after he came out of college. And so he understands the concepts right from that. And so sawmills and paper mills, as I understand it, and how he explains it, is they have byproducts such as sawdust and bark, right, that they can't necessarily create lumber with or paper with, right? But what they can do is they can burn it, which can then turn dynamos, which can create electricity. And they can then take care of the electricity needs for their paper mill or sawmill, right? Well, what if they produce 125% of the electricity that they actually need? Now they have a surplus, right? What do they do with the surplus? Well, the idea would be we'd sell it, right? Oh, well, are we going to sell the electricity? Are we going to actually go set up a grid and put telephone poles up and electricity poles, right? And put all that up and then get that to the customers, have a sales force, do all of those things. Well, of course not. That's crazy, right? The idea of that. The logistics and the cost of that alone is astronomical. So what do? Well, instead, why don't they sell it back to the power company, right? Who already has the infrastructure and the business in place. They're already doing it, right? And that's exactly what they do. They sell it back to the power company. The power company has the grid, has the infrastructure, and they're able to then distribute that to the people who need it. And so, in the same way, we use a mutual insurance company with a dividend paying whole life policy, a participating whole life policy, talk about that, so that we can tap into that profitable system that's already built in rather than creating it ourselves, right? We don't have to create a bank. We don't have to create an insurance company, right? The insurance company allows us to be, as a mutual insurance company, they allow us to be a participating member of that, a part owner in that setup. And so we're able to then participate in the profits, the dividends of that insurance company. So imagine you have a company, right, that has a track record that they've never missed profitability over 120 plus years. Imagine that. If you had that kind of a setup and you could tap into that and you could be a member of that or a partner, in that, and you could actually benefit from the profitability of that company and actually participate in the profits of that company without any hands-on participation in the day-to-day operations of that company. Wouldn't that be great? Well, in the same way, you can do that with the insurance company. They allow us to buy one of these participating whole life policies that pays dividends and that gives us this guarantees, right, that we're looking for and ensures that we have a growing asset, a cash flowing asset, right, that continues to grow without us having hands-on work that's involved in it on a day-to-day basis. Of course, as a great benefit to this, it happens to be life insurance. So we're getting a death benefit, right? We're also getting living benefits if we get sick. And that's another aspect of this that we don't talk a lot about. But just the idea that we can build a system of these policies, not just one, but a system of these policies that builds our banking system and allows us to then participate in the system that's already built and enjoy that profitability from that system. Think about it. They have paid dividends, the companies that we use, from 120 years old to 160 years old. They've paid dividends every year consecutively. Think about that. Not many businesses can say that. I looked up Coca-Cola. They've paid a dividend every year for over 100 years. That's pretty impressive, right? There's a few other companies that are listed that have that kind of reputation. And these insurance companies that we deal with these policies are one of them. So that's through the Great Depression. That's through multiple world wars. That's through the Spanish influenza of 1918, which killed nearly 700,000 Americans. Think about that they were that financially stable they could endure those type of things, including with Spanish influenza in 1918. That right there, you would think would affect those insurance companies in a huge way because we lost a lot of folks. But they were able to endure. Why? Because they're built for this. They're built for this. And so we get to participate in that. And so just in the same way that you could participate in the benefits of selling electricity, right, that you have as a surplus in solar, you do this sometimes. People have solar panels on their roof. And if they have a surplus of electricity with their solar panels, they can often sell it back to the carrier or the utility company. And the way that they do that is sometimes in the form of credit or actually in the form of money coming back to them because they're now putting electricity into the grid that can be used, that they didn't have to maybe burn diesel fuel in a generator to do that, right? So that's the idea of this. The insurance company's already done a great job of this. They've been doing it for over 120 years. Why not participate in that with the money that we're already spending? Let's go back to our spreadsheet. Let me share my screen real quick. I've been going over this spreadsheet over the last couple of lives, and I hope I'm not wearing anybody out on it, but I think it's useful to show this concept. And so as we talked about before, just taking expenses that we already have, like a mortgage of $2,000 a month, and funneling that through the system, right? You're paying the same amount of money, whether you paid your mortgage with this system or without it, you're going to pay the same amount. But the difference is you funnel that money through your banking system, whether it's one policy or multiple policies. In this case, I do an example on the spreadsheet of just one policy that we built for this, right? And so you can see, look at these dividends right here. These dividends, just by age 85, if you started at 40, you've got a dividend total of around $1.2 million, which is far more than you've put into this cash flow wise, by the way. I think this cash flow wise, you've ran about $700,000 or so through this system. You have about 1.2 million projected in dividends alone. It could be more than that, depending on interest rates. We're seeing the interest rates have risen, and so dividends are starting to pick up, right? And a lot of the illustrations that are out right now are based on the dividend scale of the low interest rate environment. So we're going to see some pickup in that, right? Total cash value by the age of 85 is about 2.3 million. Think about that. All you did was pay your mortgage. If you don't understand what I'm talking about, go back to my last two lives and you can see that all you're doing is paying your mortgage. You're already paying that, right? But if you can funnel that money through the system over a 30-year period of time, plus, we start to see this amazing effect. Now, remember, we had access to use this the entire time. We talked about this, right? We were able to use this if we wanted to buy a vehicle. We could use this to purchase cash flowing real estate, which I highly recommend as another asset to have in your financial system, right? That is producing cash flow. This is a cash flowing asset, though. This is the equivalent. A whole life policy like this, built this way for high cash growth, is the equivalent of having a business that you have no hands-on work that you put into every day on it, right? How many of you would love, you've got a business maybe already and you pay this much for these overhead costs and you have this much amount of hours that it takes to put into that business each week? What if you had a business that had no hours of overhead, right? But yielded a cash flowing system? Look at this. Like I said, by 85, projected to be 1.2 million in dividends. It's pretty impressive when you think about it. And so this concept, if we did this with our expenses, if we did this with all the ways that, or all the things that we're already spending on, and all we did was change the flow of that money through our banking system, imagine if we did this with all of our expenses, not just a mortgage, right? And so we can use the concept of cogeneration to understand that by using and tapping into this setup that the insurance companies have done such a great job of putting together, being a partner in that, without taking on the risk of owning a bunch of Coca-Cola stock and what the potential might happen for the Coca-Cola stock, right? This is different. We're not having the risk of loss involved. Once the dividend's declared, and once our policy grows, like I said, contractually every day, that can't be taken away from you. And that's an amazing thing. And so Nelson's concept was, we can't necessarily go out and start a bank, and we don't need to. But this is another way to accomplish the same thing. Building a banking system and using the tools. It's interesting, if you look at insurance companies, they oftentimes are financing in blocks of money the loans that are actually going out to build, buildings and commercial real estate. And so these banks are actually buying blocks of money from oftentimes the insurance companies to do that. So it's kind of an interesting thing. You're kind of cutting out the middleman, right? Going straight to the insurance company. They're providing capital for a lot of things out there. And so that's what I'm going to go over today. If you have any questions or comments or anything you want to add to that, please reach out and I will continue to look at this. We're probably going to do an example next that will deal with not just the expenses of a mortgage, but rather quarterly expenses total that you have as a household or as a business. And look at what that can look like. The goal of this in Nelson's book, and this could take 15 to 20 years to do, the goal of it is to match income to premium, income to what you're depositing into these policies. And that's something that takes some time to accomplish, but you build up to it. If you can do that, think about it. You're running every dollar through someone else's bank right now. Why would you not want to run every dollar through your own banking system? Take care of your family, protect them with that death benefit, also with the living benefits if you get sick, right? And at the same time, have liquid money available that you can use for your purchases, your investments, different things like that, without ever losing the growth. Remember, you could buy a piece of cash flowing real estate out here at end of year 4. You have 88,000. You buy a piece of real estate for 50,000. I know that doesn't seem that possible, but in the Midwest, it still is. And it's a cash flowing piece of real estate, a rental, for instance. And your money never stopped growing, even though you took 50,000 out. Remember, it's a policy loan, right? So the policy, the money keeps growing in that policy, uninterrupted, true uninterrupted compound growth. So I'll leave you with that. Thank you so much for your time. You guys have a great rest of your day. I'll see you next week.